So as you know about intangible assets are the assets which do not have physical substance. Okay, no physical substance for intangible assets. So intangible assets recognition criteria is this definitely is owned by the owners of the company, controlled like owned by the owners, controlled by the entity, and on this the owners would get future probable economic benefits, and it should have some cost. Okay, its cost should be recognized. Okay, if cost cannot be recognized, that means if you cannot find out the cost of this, then if it doesn't have a cost, let's say, then you cannot show in the books, right? So like first and foremost point is it should give you economic benefits, and second point is its cost should be recognized, right? And the examples of intangible assets are patents, copyrights, trademark. Okay, goodwill is also an intangible asset, but I tell about goodwill. What is goodwill? Only goodwill created in case of acquisition of business. Can be shown in the books. Okay, internally generated goodwill cannot be shown. Internally generated intangible assets, either any asset. Okay, first of all, goodwill, if it is inseparable and not separately identifiable, I am using two words. So let me go like deeper. Any intangible asset which is separable and which can be separately identifiable. That means the asset can be separated from the business and it can be sold in the market. Then those kind of all those kind of intangible assets can be shown in the balance sheet as an asset. Okay, but internally generated assets, that means intangible assets, like any kind of softwares you make. Okay, softwares you develop, if you can separate it and if it is separable and separately identifiable, and that means you can separate it from the business and sell it in the market, you can get a value for it, then you can show. Otherwise, internally generated intangible assets which cannot be separated from the business or which cannot be separately identifiable cannot be shown in the books as assets, but expenses related to these assets should be accounted. Expenses should be accounted. Okay, and any intangible asset created in case of business acquisition like goodwill can be shown in the business, can be shown in the books. Okay, in the balance sheet. That means goodwill which is inseparable cannot be shown, but which is, you can that means here there is a value which has got created in case of goodwill. There is a value which has got created in case of goodwill, right? So this is the point. And in case of, now coming to recognition criteria, things are clear. Now coming to measurement basis, you can show the as per IFRS or IAS 38. The intangible assets, what you are showing, you can show at either historical cost or revalued amount. The same treatment for what you use for tangible assets. Same treatment what you use for tangible assets is applicable for intangible. Here less historical cost and less accumulated amortization. Only in case only instead of depreciation, the word what I'm using here is amortization. Accumulated amortization should be deducted. If you are revaluing the asset, next year onwards on revalued amount you will calculate the depreciation. Okay, every treatment what we discussed about reversals, about reversal of like previous revaluation surplus or reversal of previous impairment loss, all the treatments are same in case of tangible and intangible assets, so nothing to explain. The same as per International Accounting Standard 38. Same goes with US GAAP as well. Same you have to show at historical cost. No revaluation surplus is allowed, and revaluation gain would go in OCI as per IAS International Accounting Standard, but as per US GAAP there is no upward revaluation. Only impairment losses can be shown. The treatment related to impairment loss is same in both the cases, in IAS and US GAAP, but there is no reversal kind of case. Only IAS allows that. US GAAP does not allow that. It should be very clear. And what more I have to explain about intangible assets? Yeah. So there is some small difference I have to explain you. The goodwill is some asset which cannot be amortized. Only impairment review should be done for this. That means every year you have to check whether the goodwill value is going down. Okay. So impairment review, here also impairment review, but here can go up or can go down. Here either it can go up or it can go down. So both things are allowed here. And one more point I was trying to say you. Goodwill can never be amortized. Goodwill can only be checked for impairment whether its value is decreasing. Here it is increasing or decreasing, both we can check. Accordingly we can put the amounts in other comprehensive income. If it is increasing, it goes in OCI as revaluation surplus, and if it goes down, impairment loss in the SOPL, statement of profit or loss. Some more points related to like intangible assets is research and development. Research is an expense as per International Accounting Standard. Development is an intangible asset. Okay, as per International Accounting Standard 38, but as per US GAAP, research and development both are expenses. Okay, that you should be understanding. And all the cost here, what is, how will you calculate the historical cost? The intangible asset value as well as all the legal expenses what you're recurring to, make that or to, so that everything related to that particular intangible asset gets transferred to you, all the risk and reward. For that you hire a lawyer and pay a solicitor's fees or lawyer's fees. All this should be added to the intangible asset value. Okay, any subsequent expenses should be expensed. Subsequent expenses related to, like, after the intangible asset has been considered in the business. So any further expenses, basically you won't find any further expenses, but any kind of legal or some expenses which regularly you are incurring or of recurring nature, any expenses you are expending, you should be showing in the P&L. Okay, that's all about this. And intangible asset, and now we will discuss about the assets held for sale purpose. And as I told you, when you revalue the intangible asset, you have to show a revalued amount, and depreciation will be calculated on the revalued amount. And accordingly, the changes in the income statement in the value of the asset, if it's increasing and decreasing, how it should be shown, I have explained you. Increasing is surplus in OCI, decreasing in statement of profit or loss. And here only decreasing, increasing is not allowed in US GAAP. So already we have discussed this in the previous chapter, understanding balance sheet as well. I don't think any kind of I have left out anything. Yeah, so goodwill, how to calculate, they have given here. Purchase price, what the company is paying, let's say $100. Fair market value of net assets acquired. This is represented by equity actually. Okay. Fair market value of net assets acquired, let's say the company, let's say A company wants to buy B company, and B company's fair market value of net assets acquired. Net assets is nothing but total of asset minus external liability. That is nothing but equity. So net asset is also called as equity. So we are taking the company B's equity, which is nothing but net asset. You already know you only own the company to the extent of equity what you have invested, because this equity has gone for the purpose of buying the assets for the company. Okay, and anything whatever you have bought by taking loans, you do, it doesn't belong to you. What only belongs to you is the your equity. Let's say you bought a car for 10 lakhs, okay, and you paid a down payment of 2 lakhs, 8 lakhs you took loan, so you only own 20% of this car, not the 80%. So your net asset value is 2 lakhs. How? Total of assets minus external liability. So total of assets is 10 lakhs, external liability is 8 lakhs. So net, so your equity is 2 lakhs, right? So that's what here. $80 fair market value of identifiable intangibles previously not recognized. If any intangible assets fair market value of identifiable intangibles previously not recognized, if at all anything is there, let's say that's of $10. So you are paying excess amount of how much? $10. That is your goodwill. Okay, this is if it is if you have not previously recognized. And you already know goodwill, if at all $100 is the value of the company and we are paying $120 to buy that, $20 is goodwill. But if, and this should be shown as an intangible asset in the balance sheet. If we are paying $80, there is a negative goodwill of $20, which is a one-time gain, should be going in the SOPL. And any gain or any kind of gain you've got, you have to show in the income statement, and you have to adjust the asset value in the balance sheet. Okay. Here also you have to adjust the value of the asset in the balance sheet. You have to show at $120. So one treatment always in the balance sheet and one treatment always in the statements. This is done. Okay. So impairments we have already discussed. Fine. But only we have to discuss the de-recognition. We have done a question also on this. When will you de-recognize an asset? When you will sell it, or the asset has become of obsolete nature of $0. That means almost there's nothing left over in that asset. So you will de-recognize it. That means when you sell the asset, of course, you are going to get some. So let's say you had an asset of $100, and after 5 years, the depreciation deducted $50, and the asset is of $50. You sold it for $70. So you got a gain of $20. That is always shown in the P&L, and gain on sale of asset. And now your asset, which was of $50, you sold for $70, right? Will you still show this asset in the balance sheet if you have sold it? No, you will de-recognize it. That means you will remove it from the books. Now, there's no need to show that, right? Because you have sold it and you have accounted the profit as well. And $70 goes in the cash account. That's it. Finished. So now there are certain points we will discuss. Impairment reduces an asset's carrying value. Of course, an asset's value is decreased when there is an impairment. Impairment charge is recognized as a loss in the income statement, and it reduces assets and equity. Yes, if at all $100 was your income, now because of impairment loss of $20, your income has become $80, and you transfer less amount, right? Instead of transferring $100, you are transferring only $80. Now what happens, like your asset was of $100, now your asset is of $80. It has, your asset value has decreased, right? Oh, sorry, this is income statement, right? Your net income was 100 before any impairment losses recognized, and now impairment loss is $20. Your net income after adjusting impairment loss is $80. Your net income has decreased, and this amount you will transfer to retained earnings instead of transferring $100. So $20 less you are transferring to retained earnings, and in the balance sheet your asset, let's say your intangible asset is of $200, and because of impairment loss of 20, now your asset has become $180, and it has reduced the asset value also from 200 to 180. So that's what they are saying, reducing assets and equity in year of impairment. Yes, when there is a loss, return on assets and return on equity will decrease because the impairment charge reduces net income. Yes, because the numerator has decreased. Return on asset formula is net income by average total assets. So here the reduction would be more, and see, reduction is happening in both the cases, but here the extent of reduction will be more, and if numerator decreases, the ratio decreases. You can practically do questions on this. And also your ROE will decrease because net income is decreasing, numerator is decreasing more than the decrease in denominator, so that will make the ratio to decrease. In subsequent periods, coming periods, net income will be higher. Because why it will be higher? It will be higher than it would have been without the impairment charge, because depreciation or amortization will be lower. Yes, why? Because now there is an impairment you have recognized, right? Asset value has decreased now. Now the depreciation amount will be less. You will every year show the depreciation, but not on a higher amount, but on a lower amount. So this will decrease the depreciation expenditure than the previous amount. Previously your depreciation on $100 was $10, 10%. Now on $80 your depreciation will be $8, 10%. So $2 the like expenditure has decreased, that will increase your incomes, and then your ROA and ROE will increase in the upcoming periods, in the future periods, right? Please tell me, did you understand? I'm asking you,
yes,
did you understand? Yeah, Pawan, did you understand?
Yes, sir.
Okay, Pawan. If you haven't understood, no problem, again go through this and then you can ask me questions. Both ROE and ROE will increase. Yeah, this were discussed. And asset turnover will increase in the period in which the impairment charge is taken and in subsequent periods. What is asset turnover ratio? Asset turnover ratio is sales by average total assets. Because your asset value will decrease and sales will have no impact in its value, numerator is increasing, so your ratio will also increase. Assets are decreasing because of impairment, right? And asset impairment has no impact on cash flow because it's a book figure, because impairment does not reduce taxable income. It is an unrealized loss until the asset is disposed of. Yes, this is the most important point you have to remember. Though it is shown in the income statement, it is a non-realizable nature loss. Okay, please read these points. We will move forward. Now, analysis of impairments. An impairment loss essentially indicates that firm has not recognized sufficient depreciation or amortization expense and has overstating earnings as a result. So an impairment loss essentially indicates, if there's an impairment loss, the asset value has decreased. That means if the firm has not recognized sufficient depreciation or amortization expense and has overstated earnings as a result. Yeah, if there is an impairment loss in the value of the asset, you should recognize it. If you don't recognize it, then what is going to happen? So if let's say there is $100 the asset value and you have not recognized the impairment loss. Let's say the impairment loss is $20. Okay. If you like impairment loss essentially indicates that, most importantly indicates that firm has not recognized sufficient depreciation or amortization expense. Now what happens? The asset becomes $80. Now the depreciation is $8. The depreciation has decreased and this will overstate the earnings, right? Yes. Hello. Yes or no?
Yes, sir. Yes, sir.
Yeah. So the judgment required in determining asset impairments gives management considerable discretion about timing and amounts. That means they have to timely do this so that they can actually show the actual value of the asset in the books. Alternatively, existing managements may take more impairment charges in periods when earnings will be poor, and because of that they want to show more losses and they want to save taxes. That can be a reason. Okay. And like alternatively, existing managements may take more impairment charges in periods when earnings will be poor due to external factors. New management may also choose to take more or greater impairment charges when they take over. In either case, the resulting low earnings might not be perceived as fault of management, and lower values of assets and equity give a boost to ROA and ROE going forward. Yes, because of this the asset values will decrease more. They are showing more impairment charge, not less. More impairment charge, that means asset is decreasing more. The impact of decrease in the asset is more than the impact of decrease in the earnings, right? Because of that the denominator will decrease and the ratios will increase. So indefinite lives, I already told you, cannot be amortized, can only be reviewed for impairment. Like goodwill does not have a definite life. You cannot show the assets, you cannot show you cannot sell the assets in the last moment and show losses on that. If you have that intention, whatever asset you want to sell, you have to put that in the asset held for sale category, so that in the future there cannot be any surprising element. That means there will be a question from the shareholders, why did you not disclose about this in the past, and why did you suddenly sell it? And then recognizing losses so that taxes can be saved, or some agenda you may have, or you may show losses. So if a firm intends to sell an asset, that means they have an intention to do that. It is probable that asset will be sold. Yes, if I have an intention, I will definitely sell. And the asset is available for immediate sale, then it must be reclassified as held for use to held for sale. That means reclassified. You should change the classification of asset now from use to sell. Held for use to held for sale. When a firm reclassifies an asset as held for sale, asset is no longer depreciated or amortized. Very important point. Please make a note of all these points. Whenever you show the asset in held for sale category, now onwards you will never depreciate or amortize that asset. Amortization in case of intangible, depreciation in case of tangible. The held for asset is impaired. That means you should only check whether the value in the market is increasing or decreasing, and you have to account it. Okay. Impairment is of course only possible when carrying amount, the value which you are showing in the books is more than the fair value, less selling costs. That means it's NRV. Okay, that means you are showing $100 and you are getting only $80. So $20 is your impairment loss. If the impaired asset is written down to net realizable value, that means you have to now show the value at this. How? $100 asset minus impairment loss $20, and $80 is the net realizable value. You have to show this in the books now. Loss is recognized in the income statement of this much extent, $20, because you have incurred a loss, right? For long-lived assets held for sale, the loss can be reversed under IFRS and US GAAP if the asset recovers in the future. This is the most crucial point. In US GAAP, we never see reversals, but only in case of held for sale category assets, the loss can be reversed under IFRS or US GAAP if the asset recovers in the future, or if you get a higher value of that asset. However, loss reversal is limited to original impairment loss. That means you can reverse the loss. Okay, that means the value of the asset has gone down, right? That's a loss for you, and that is nothing but the impairment loss. So the reversal can only be to the extent of impairment loss. Thus, carrying value of the asset after reversal cannot exceed the carrying value before the impairment was recognized. That means I'll put a practical point here. $100 is the asset value, okay, and it has the value has gone down to $70, right? So the impairment loss what is shown is $30, right? This was the carrying amount. This was the net realizable value, or this is the book value. This is the fair market value. This is the impairment loss. Now, if the reversal happens in both US GAAP and IFRS, you can recognize, but to the extent of only $30, that is impairment loss, but not beyond this. That means if you think that asset is going to $120, you cannot show that or account it. Only this much you can reverse. That's it. Derecognition: when you are selling the asset, you have to remove the asset from the books. That means you are getting $100 for selling the asset, and after 5 years you are getting $100. Asset value is $50, so your gain is $50. That means asset you bought for $100. No, assets value when you are going to sell in the market, you're getting $100. Asset after 5 years, depreciation deducted, is of $50. So $50 is your gain from the asset, and now this asset which you are selling will never be recognized in the books. Now there is a point here. If it is a profit, you will show in the SOPL. If it's a loss, you will show in the SOPL. Give me a second. I'll just drink some water and come. Now, the gain or loss is reported in the income statement with other gains and losses, or reported separately as an unusual or infrequent item of material. If material, sorry. See, selling assets is not a frequent thing which happens in the business. It's a very infrequent thing. So you can show the profit or loss in the business. Also, a firm represents, if at all there's a cash flow statement which a firm makes, and you are preparing the cash flow statement by using indirect method, the gain or loss from the sale of asset is removed from net income to compute cash flow from operations. So this we will discuss when we'll be doing cash flow statements. I understand you may have an idea or not. I don't have that idea, but what I'm trying to explain you is, while you do the cash flow statements, you would be starting with net profit in the indirect method, and then from net profit you have to convert that net profit to operating profit, and from operating profit you have to convert that into operating cash flows. So when you convert net profit to operating profit, what happens? Like I would just not explain right now, because it will take very long time for me to discuss this. Instead, if you want, for your curiosity, I can give you a video to understand. Okay, cash flow statements. I will take the class, of course, in the future, but if you want, you can just go to the cash flow statement videos of mine and try to build your concepts. Once, only in advance, then we will definitely go for the class. Just a second, I'm giving you.
Thank you.
I hope you got the videos which I've sent right now. So please watch this. Okay. Okay, now let's move forward. Just give me a second. Yeah. If a long-lived asset is abandoned, the treatment is similar to sale. Abandoned is nothing but you don't want to keep that asset with you. You want to remove it from the business, and is similar to sale, except there are no proceeds. That means you will not show any sales figure. In this case, carrying value of the asset is removed from the balance sheet, and loss of that amount is recognized on the income statement. The whole amount would be a loss amount. If the long-lived asset is exchanged for another asset, that means you are giving your asset and taking another asset. So what happens? You give your asset and you give amount also. Let's say you bought an asset for $10. Now you have used it for 5 years. The value of that asset, what you are going to get in the market is, let's say, $3. So now you are exchanging this asset with another asset. This asset what you are buying costs you $15. So $3 you will give the cash. That means this asset this asset of $3 worth you will give to that company with whom you want to exchange your asset, and also you will give $12 extra cash to that company for exchanging this asset with you. Am I right? So if a long-lived asset is exchanged for another asset, a gain or loss is computed by comparing the carrying value of the old asset with fair value of the old asset. That means, let's say this particular asset which you are going to exchange, the depreciation you have done and the asset is worth of $2, but you're getting $3. So that means the asset has got depreciated by $8, and now the carrying amount of the asset is $2, but the market value for this asset, that means the one with whom you are exchanging is ready to give you $3. So $1 profit you have made from this transaction. Please tell me, did you understand? Hello?
Yes, sir.
Yes, sir.
Yeah, and now what happens, the asset which you have got, the one which you have exchanged right now, the old asset you have exchanged with new asset, the new asset you will be showing at its fair value, that is $15 in the books, and the old asset will be derecognized or removed from the books now. But in this case, there should be a fair value what you should be getting for this asset. So if no reliable measure of fair value exists, the new asset is valued at carrying value of the old asset. So if no reliable measure of let's say if you are not getting fair value, you have to show the asset at carrying value. Okay, that is $2 only. In that case, showing profit or loss would not be something which would be feasible. Okay, only the profits or loss can be shown if there is a market value available for an asset. Okay. Market value or fair value. Now spin-off. So this is a spin-off. You should understand what is the spin-off means. See, a spin-off is transfer of assets that constitute an entire division or subsidiary into new legal entity, upon which the shares of the spinnee are subsequently distributed to shareholders, and the shareholders do not surrender any stock of spin-off. Let me just see what is left over. Spin-off we will discuss afterwards. Okay, not required right now. Because
Can
it
you
doesn't.
explain the paragraph above that?
Sorry?
Can you explain the paragraph above that, above spin-off?
This one? Yeah,
Yes, sir.
I
Yes, sir.
explained, right?
Yes, sir.
I explained with an
Yes, sir, I didn't really get it. It says that we are comparing the value of the old asset to the fair value. We are comparing carrying value and fair value. But why
Of
would we do
course.
that, sir?
Why will you not do that to recognize gain or loss?
So because we are exchanging one asset for the other asset. So
Yeah,
for
you're
the old
exchanging.
asset, if we
In
are
that case,
taking,
if you get some gain, won't you recognize? See, if a long-lived asset is exchanged for another asset, a gain or loss is computed by comparing the carrying value of old asset, which was $2, okay, with fair value of the old asset. So for old asset, what I have, I'm showing in the books $2. The company with whom I'm exchanging is ready to give me $3. So what? If they're ready to give you more, won't you recognize gain?
yes, sir.
Tell me.
Yes, sir.
That's what. And you'll remove the asset from your books. Recognize the gain. That's it. Any doubt?
No, and the new value will be recorded, new asset will be recorded at?
Yeah, now the asset what you are getting is totally of $15. That will be shown as $15.
Okay, okay, sir.
See, what is happening is you have a asset of $10. Today its carrying amount is $2. Now you are exchanging this with the other company, and the asset which you are going to exchange with the other company values $15. Its market value. For this old asset of $2, they are ready to give you $3. Okay. Hello.
Yes, sir.
And
Yes,
you
sir.
got $1 extra in that case, and you are paying $12 to them. Additional. Otherwise, you
Yes,
would
sir.
have paid how many? Otherwise, you would have paid how much dollars?
$30.
That's what. Understood?
Yes, sir.
Tell me, Bhargav.
Yes, sir.
$10 worth of asset today its value is $2 in the books. With the asset which we want to purchase is of $15 fair market value. The thing is, you have to give the asset worth of this much to them and also additional cash to them. But for this asset, they are ready to offer you $3. Okay, so $1 you got. Okay, and rest how much dollars you have to pay them?
$12.
$11.
11.
Okay, 12. That's
Yes.
totally $12, right?
Okay, sir.
Otherwise, you would have paid that from your pocket. That's it. So $1 gain, what you got is your profit. You got a difference extra $1 amount, right, for the same asset.
Yes, I understand.
Yeah. Spin-off we will do in the next session. Not relevant topic right now because we are in the mood of finishing the accounting this thing. No need to do that spin-off right now. However, we have to take one more session tomorrow to finish this. So okay, now we will stop here. The reason for that is already this topic is done. Tomorrow we will discuss about the disclosures and spin-off thing. Okay. So meanwhile, I have sent you the cash flow statements. You go to that cash flow statement video and try to build your concepts because next class we will take cash flow statements only. Understanding?
Yes, sir.
Okay, so spin-off we will discuss tomorrow. Disclosures are nothing but already I have explained you about disclosures as well. So I don't think I have to explain you much about disclosures. We had a good amount of discussion for that. Analyzing long-lived asset disclosures, we will discuss the concept of ratios tomorrow. That's it. For that, I am taking one more session tomorrow. I will see if I can finish this in very small time. I will try to finish and we'll also enter into next topic. Okay. So what we have done? We have done financial statement analysis. Balance sheets is done. Next, we will do cash flow, right? Cash flow. Two topics are there. This is by tomorrow I will finish this. Yeah, okay. So we will see some points related to disclosure because I think we have how much time left over. So already 50 minutes is done. Okay, we can go for a 5 minutes discussion and then close. See, what is disclosure? The certain data which you cannot show in the books, you will show in the footnotes. That is disclosure in the disclosure column, right? So what can be that data? The data is nothing but additional information about the asset, like from whom you bought, at what price you bought, what is the method of depreciation you are using for depreciating your assets, what's the rate of depreciation you have estimated, if you like during the lifetime of the asset, have you purchased some additional asset, have you done some improvements to your asset, if if there is have you gone for an impairment review, if there's an impairment loss, then you have to mention about that, if there's a revaluation surplus, you have to mention about that, if at all there is a reversal of revaluation gain, you have to mention, if there's a reversal of impairment loss, you have to mention, if you are derecognizing the asset, you have to put that in the held for sale category. So have you done that, you have to disclose. If at all you are selling the asset, you are going to derecognize the asset and you're going to gain some thing out of it, out of that transaction, you have to mention that even. So all the things you have to mention, nothing you can hide about that asset to the shareholders. That is the beauty of the standards, I have to tell you. So standards have made it so tough for the perpetrators of the crime, or the ones who want to defraud the company or fraud, or make some bucks out of the fraud. They want to commit very minimal. Okay, there's very less scope they are leaving these days, and they're making it more and more stringent. Same applies in IFRS, and the same kind of disclosures applies in US GAAP. Only certain difference in the standards, which we have already discussed while we started the chapter. So disclosures is also almost done. Most probably you won't get questions from disclosures because those are not technical topics. Any Tom, Dick and Harry can understand what is disclosure and what additional information you are showing about the you are disclosing about the asset in the disclosure column. Okay, fine. That has nothing to do with the treatments. Only what you have shown, you are giving some additional information about that. Fine. And if you want to change the depreciation method from straight line to diminishing balance, it's called change in estimate, and that also you have to account. Okay, if you want, if the accountant thinks that they want to change the method from straight line to diminishing balance, so that is called change in estimate, and change in estimate should be given prospective effect. Change in accounting policy, if you are changing method from LIFO to FIFO, I'll tell you what this is afterwards. You have to give retrospective effect. I'll explain you this afterwards, but right now my topic is this. Prospective effect is if I'm changing the method now to diminishing balance, from now till the next change, what I do, I have to follow diminishing balance method. Okay, or if I want to change the estimate, that is rate of depreciation from 10 to 12%, till the next change I make, I have to maintain 12% only. That is called prospective effect. Okay, so all these things you'll be finding in disclosure. Disclosure thing is also done. Tomorrow we'll see some leftover critical topics are there or not, and spin off hardly 20-minute session, and we'll move to the next chapter. Okay, thank you.